Ladies and gentlemen, good morning. Let us very quickly review the price action from last week before we go on to some macro themes which I'd like to explore with you today. Well, the 2-year note did very little. On a weekly, it can be seen it was a very small negative week. Literally 2 basis points, as you can see on the dailies. What is that telling us? That is telling us that the market has given up on its bullishness and has basically gone back to saying no change in Fed decision making for the foreseeable future, probably for a very extended period of time, and therefore the yield curve is now flattening again. The 2-year note, this is the action for the week, had a very small negative week. It's come back right into the area that we consider the neutral area, i.e. the no change in policy. Below this line 109.03, we'll be looking for a tightening. Here we're looking for nothing. This is bullishness, and this is actually easing above here. The 5-year note, very small price gain, so this is exactly what we are saying. We're saying that the yield curve is now flattening again. The market has come back into the neutral area. We think the odds of it going back into the bullish area for next week are quite small, while the 10-year is slightly more bullish, but not incredibly so. Again, it's gone back only to the bullish area as opposed to the completely neutral area, which shows you nothing more than the yield curve is flattening and continues to flatten, which in a market where the equities are rising is also a warning sign for the future. The 30-year note is doing exactly the same. It is still in the bullish area. It is well supported by the technicals. It is basically basing in this area, or if not basing, then it's compressing in this area, and the decision is being postponed by the market about what the next major direction is. Much the same can be seen in the European markets. This is Schatz. This is the area that we indicated would be the neutral area, and above it it's still the bullish area. We're still in the bullish area. The market is still anticipating more future action from the ECB as opposed to less action, and that is reflected in the bubble, which is still way above, I mean not way, still above the very important levels that it needs to remain above for it to have a chance of making new highs. That's 133.20 is the absolute key for the bubble, as for the Bund we have a very similar level, which is 165.60, 165.50. If the Bund, look how many times it's now tested that area, once, twice, 3 times. Unless the Bund can break 165.60, it is liable to squeezes higher, probably to squeezes even above the high 168 area. So there is absolutely no reason to be short of European bonds unless the market breaks 165.60. anything above, you are liable to be squeezed by 100 to 200 ticks at any moment for whatever reason. In fact, probably for no reason whatsoever. That can also be seen in the Italian bonds, which unfortunately the future source does not have much data on the Italian bonds. As you can see, they're still very much in a bull run, which basically means that the spreads between German bonds and Italian bonds are still compressing inwards. People are chasing yield. Why invest at zero in the bonds when, or slightly negative, when you can get, I don't know, 1.5% roughly in Italian bonds? So this is showing you that people have absolute faith in the ECB's ability to keep Italian yields and Spanish yields, Portuguese yields, Greek yields under control through their QE purchases. A very quick look at the gilt yield. Unfortunately, TradeStation doesn't have that much data, doesn't have continuous data. Just shows you that the market is in a wait and see mode. It's probably making a daily bull flag here, and it's just waiting for the next B of E signal. This is the move of Brexit, and this is what we have done since, which is absolutely nothing, consolidated the gains, and therefore probably waiting for another push higher. Considering that yields in gilts are now below 1%, which is a record low, that tells you that we probably will go towards 0.5% in yield and maybe even down to zero. So the UK, far from Brexiting, is actually joining European yields at 0%, looks like, in the next few months. Let us now look at some other asset classes. This is the DX, which is the dollar, which is the one that we were so perplexed about as it was being contained by this 96.50 area. Well, it's busted this week. We have gone to the top of the daily Bollinger Bands. We are above the 200-day moving average. Very strong chart showing that if 96.50 contains the retracements down, we will probably go up to 100 by the end of the summer, or maybe sometime in the autumn. Very strong chart. Pullbacks are to be bought. It's as simple as that. That is actually reflected also in the weekly chart. It is vastly overbought at these levels, but all the moving averages are now turning, even the shorter term ones, and this is not such a short term one because it's a 50 week. It is now showing you increasing signs of strength. We would have thought in the next few weeks it'll definitely trade 98.33 and then attempt the 100 high, which is going to be very significant for our argument in equities, which is to follow. We can actually see this reflected in the euro chart, which is, this is the daily, which is actually now showing increasing signs of basically rolling over. The moving averages, this is a 100-day moving average, this is the 200-day moving average, this is the yearly pivot at 110.50-ish. We keep on trading below the yearly pivot. The Bollinger Bands are showing huge signs of compression and will now start opening outwards, and we could, after a few days of sideways movement, have the beginnings of a cascade lower in the euro, and basically this is just showing you exactly the same, confirming the DX chart. We would not be surprised that if by the end of the year we've tested the 104.60 area again. We're not saying we're going to go and bust it, but we're certainly thinking that the direction is now pretty much set, and we will be going from 110 area down towards the 105 area, which is a 5% move, and it is quite significant. Don't forget that we started the year around the 10, what level is that, with around the 108 area. So we are still a couple of percentage points higher than we were at the beginning of the year. That is significant because the move this year has been minute, and therefore we don't think there's going to be a huge amount of resistance from any of the central banks to see a lower, weaker euro. I don't think the Fed is going to be too upset by 1 or 2 or 3%. I don't think the ECB is going to be upset. In fact, they'd probably welcome it. So the path of least resistance for the euro for the time being definitely seems to be lower. It is oversold, but these oversold conditions can persist for quite some time. So that is as far as the dollar is concerned. Let us now turn to gold before equities. The gold chart is actually very similar to the bond chart. We have retraced some. We are coming into good support areas around 1280, 1290 to 1300. We have worked off the overbought levels, but we do have some negative divergences in the RSIs, so this is quite likely to continue down into the 1290 area, which will get a lot of people very excited, but not us, which is what we will show you in a few minutes time. This market is still contained by this trend line. It failed at the breakout point. It now has plenty of room to come back down even towards 1200 or even 1210. We think that is actually quite unlikely. We are more likely to form some sort of weekly bull flag here just underneath the 1350, 1360 area. So trade in a 1280, 1330, 1340 area for quite a few weeks, and we will explain later why we think so. Let us now turn to the equity market, starting with the US. And here we've had something which we haven't seen before. We've gone back over 30 years of data and we can't find it. Maybe we are wrong, but we haven't been able to find a single week where the market has traded wholly above the weekly Bollinger Band. We've gone back over, well, 50 years of data, I'd say, and we can't find it. So this is the sign of something new. Either it's a sign of too much money chasing too few stocks, or a sign of expansion, or a sign of very limited participation by players in the market and very little price discovery. Whatever you like to call it, we still think it's significant. It is unlikely to persist. We found almost, we think we found no instances of the market not retracing to the Bollinger Band at some stage in the future. Whether that is, whether it takes a week or whether it takes 3 months, it always happens. 2135 to 2140 is that area where it spiked the Bollinger Band and started trading above it. So 25.35, 25.40 becomes 21.40 becomes a swing level for the market, which basically means that if we see a pullback to 21.35, 21.40, it is a wonderful risk reward area, i.e. we want to be long there with a stop just underneath. So a stop around 21.25 when you are long at 21.35, 36, 37 is very good risk reward. If the market fails to hold at that level and falls back into the 20s, that means it doesn't mean it's a bearish market. It just means that the slope of the bullishness of this market is unsustainable, and it'll probably come and test even the 2080 area before it tries to go higher. Now, as you know from last week's video, our contention is that we are now in the fifth wave higher, which should really resemble the first wave. We could argue that this is where we are at this stage of the game, so we have quite a few more weeks, probably 3 to 4 months of working higher and going from, well, the equivalent of would have been 1,000 there to 1,125, which is, you know, roughly 10%. So we are seeing a move which at 10% indicates nearly, what, 2,400 for the S&P. The only question in our mind is how we're going to get there. Are we going to get there by being hugely overbought the whole time and not having no retracements and not letting anybody into the market? Or are we going to have huge pullbacks because people are shaken out of their positions? To our way of thinking, that is the only question, and the answer to that is we don't really care. Let's get long call options and know what our risk is and just sit with it. A lot of you were able to buy the combo at 330 that we wrote about. Lucky you. We didn't. We're going to have to rethink our strategy. So that is the ES. No reason to short it whatsoever. What we do think is that this move is now coming into the fifth wave, so the 5 of 1, shall we call it. So the next new high around the 21.85, 90, 95 area is probably a good sell for a retracement back down towards that 21.30, 21.40 area that we were talking about, 21.35, 21.45 area for the next leg higher. This market is getting very, very, very overbought, and the volatility is getting extremely low. Not that it can't go down some more. VXX is in its downtrend here has done absolutely nothing wrong. It's maintained itself below all these moving averages, which are very short term, and it's done nothing wrong. Even move up to 13 and a half in VXX is going to have no longer term significance for volatility. Volatility is still heading down, and it looks like it will continue to make new lows. Even single figures in VXX over the course of the next few weeks would really not surprise us. But this chart does concern us, and as you can see, every time the market has reached such overbought levels of of volatility indicators, it has always had a significant retracement. So we would love to see some new highs next week, taking the market up to 21.90 or so, and then a nice retracement back down to 21.35, and there we shall see what this market is made of. That should get these indicators back towards the 1 or 110 level, no longer overbought, and then we can probably have another leg higher. Turning to the European stock markets, and this is a daily DAX, they are nowhere near as bullish as the S&P or any other American market. They're still contained within this downtrend, which has been going on for well over a year now. It's a very well defined downtrend channel, and we are again going to try and test the upside around the 10,300, 10,400, 10,500 level. The next few weeks are going to be crucial for DAX. We really don't see that the market is going to be able to bust through the 10,500 area. We are prepared to be wrong, to be proven wrong, but we will be exiting all our longs around the 10,300, 400 area, thinking that any move to 10,500 is probably a good risk reward short as opposed to anything else. On the weekly charts, you can see much the same downtrend. This area around 10,500, you can see how significant it is by these lines. That'll be right there. That'll be a huge inflection point for the market. 10,477 or so, 10,500 is going to be a hugely difficult nut to crack. It'll be through the Bollinger Bands, it'll be right touching this line, and we could have a cascade lower from those levels as a rejection occurs. Much the same thing can be seen in the stocks, which is even weaker. The next move, we are still below the 200-day moving average, which is around 3,075. We could definitely see a test of that in the next few days, but 3,154 area is going to be incredibly difficult to break. But that is a big move still. That is still a 5 to 6% move before we see these incredibly difficult levels to crack, and we turn at best neutral on the European markets. The Nikkei is showing you much the same kind of picture. It is still well contained, even after this huge move that we managed to miss, although we were right in its direction. This area between 17,500 and 18,000 is going to be incredibly difficult to break, and that is going to be something that Kuroda has to be aware of next week when he comes up with his new monetary package. We tell you that because it's happening next week, so next week we might see a test of this 17,500, 600 area, and we have to be aware of it and formulate our strategy accordingly. We will talk about that in a few minutes again, but be aware that the Nikkei is still very much in a neutral frame here, trading between these two support lines, and this area here is going to be absolutely crucial for the next few weeks. Now, having gone through the state of things as they are, let us start analyzing the macro background. Now, Chris Javaku and another excellent video, all his videos every week are excellent and point out things which we should all be looking at, has pointed out that bonds, stocks and gold have all broken out of multi-week or multi-month or multi-year consolidation ranges. Gold broke first, followed by bonds, and stocks have now broken out with it. Bonds and gold are now retracing slightly while stocks are continuing. And he is asking, how can that be? Well, we don't think these are coincidences. We think this is actually a strategy. This is a way forward. We are not saying that all three asset classes will go up tick for tick. We're just making an argument that either all three asset classes go up and with different slopes of bullishness, or all three asset classes are going to turn down simultaneously. Why do we think that? Well, our basic premise about what is going on is liquidity. Sheer weight of money is driving all three asset classes. You have a situation where some people are worried about deflation. You have a situation where some people are worried about valuation concerns in the stock market. Yet you have the same situation where the economy is definitely avoiding recession. And there is hope for earnings improvement over the next few months and quarters. Brexit seems to have been contained by the easiness of central bank policy, which is driving bonds, which in turn is driving stocks. But you have also incredible worries about currency debasement and future inflation as a result, and the systemic risk in the system, and about valuations in every other asset class, and therefore some people are buying gold. We are not saying that gold must go nuclear on the upside, or that stocks must go nuclear upside, or that bonds must go nuclear on the upside. We are saying that unless bonds are strong, the bull market in stocks cannot be anywhere near as strong as it has been over the past few weeks, days and weeks. Unless gold maintains a bid, we can't see stocks remaining bid, simply because a bear market in gold is going to assume a very strong dollar, and a very strong dollar is going to be a headwind for stocks. On the other hand, a very strong dollar will presume for bonds that the Fed is not going to tighten, because the market is doing its tightening for it. So you can see that what our argument is. Our argument is that either all three markets are in a bull run, which doesn't mean that gold has to go up, it just mustn't go down, is a necessary prerequisite for bonds and stocks to maintain their levels or improve on their levels. We think there is so much uncertainty, so much overvaluation. The dollar is potentially going to get so much stronger that if one of these markets goes into a bear phase, and by that we don't mean that necessarily that gold must maintain this line, we just mean that it mustn't go into a bear market, it mustn't go below 1250, that kind of argument. because if that does happen, that's going to have a major impact on stocks, which might in turn have a major impact on bonds. We basically see these three markets now being more or less joined at the hip, loosely but joined at the hip. We don't believe that stocks can go up without some support from bonds, and we don't think that bonds can stay much stronger without some support from gold itself. To be clear, our argument is not that these markets must trade together. Our argument is that the overall direction of these markets must remain the same. Now, the 164 yield level in 10-year notes is incredibly important. We've traded below it, we've traded back to it. Now, if we go and trade much over 2%, we will still be in a downtrend, but we'll be beginning to challenge it. If we challenge the 2% downtrend and eventually break it, that will be a huge warning signal for stocks. Why would bonds make a move above 2%? That is an argument that we cannot see at the moment, but it would certainly mean huge growth and or inflation. Can we see huge growth? No, we can't. Can we see huge inflation? No, we can't. Therefore, we are maintaining that the bonds will remain in their bull market. Whether they retrace some of this move is neither here nor there. That still keeps them well within the bull market. The same thing can be said about the German Bund. This is the 5 basis points level, whether it's 5 or 6, it's neither here nor there. That is incredibly important, and that actually is equivalent to that 165.60 level that we were talking about in earlier. If now Bund start going much above 25-30 basis points, people will start talking that this huge move down is over and that European growth and or inflation is back. We can't see that happening. We don't see the Bund going much above 30 basis points within the next several months. Since our argument is that we are in a period of multiple expansion in equities, our argument also must be that that multiple expansion can only be driven by a cooperative bond market. Therefore, if yields now start spiking above 2% in 10-year notes, that argument must be deflated. Why would people be paying over 17 times earnings, forward earnings, when they can have better yields by buying bonds? And that is our argument. They're not going to get those better yields, and that is why they will continue to buy equities. There will be a scarcity of equities, the liquidity will overwhelm the supply, and we might get a period like we did, this is a monthly chart, a period like we did between 98 and beginning of 2000, when the multiples just went crazy. They went all the way to nearly 25 times forward earnings, and you can see what that would do to the S&Ps. The S&P could easily go to 2500 without anything else having moved. But for that to happen, bond yields have to cooperate and stay low. This is the weekly picture, and you can see we are now at levels which are as expensive as they have ever been in the past decade. So if this is to persist and keep on going higher, bond yields must cooperate. The consumer discretionary index still has room to go higher. Staples, if they are going to be, I mean, to us staples are some form of bond substitute with a bit of a kicker. If they are to remain at this level of overvaluation, the choice between them and 10 notes must remain pretty constant. Otherwise, we can't see why this would keep on going higher. The energy index is the one that we told you to avoid, and because you don't know, it could take a leg lower at any moment. It'll be many quarters before this makes any sense to us. The financials again are stuck. They don't seem to be able to lead, and if the financials are stuck, there are only very few sectors left which can lead the index up by a full 10%. Okay, I mean the financials might go up 3-4%, but if energy is not cooperating, and if consumer staples find it very difficult to make any headway, then consumer discretionary must have a hell of a move. And the other sectors which must have huge moves are healthcare, which is our favorite sector, industrials, information technology must have a huge move, and probably in the order of 20%. So buying Nasdaq on pullbacks might be a very good strategy. Materials must also contribute. We don't think they have much room to contribute, but they must contribute. And finally, telecom services must have a pretty humongous move, i.e. around to 230, 240 from the 185 area where they're trading at the moment. So they must really contribute, and utilities, i.e. bonds, must remain strong. We can't have a situation where this market is giving up 20% of its value and the index going up. So what we are seeing for the foreseeable future is a market where bonds remain strong, which doesn't mean they rally, it just means they don't go down very much, to enable a rise in the S&P index to levels that we haven't, of valuation that we haven't seen for many years. Now, what is going to do that? Well, we do have two very important things happening this week. We have the Fed meeting. We also have GDP from the UK, which is going to be very interesting. But on Wednesday we have the FOMC statement, which could, we doubt that it's going to move the market, but it could reinforce its view that the Fed is going to do absolutely nothing for the foreseeable future. And finally, on Thursday night and Friday morning, our time, we have Mr. Kuroda doing his thing. Friday morning really is going to be the most important time, around 1 o'clock in the morning our time, New York, which is going to set the stage for what is going to happen next. So, having identified Mr. Kuroda as a very important inflection point in the market, and having seen in the Nikkei that we have room to rise to 17,500, maybe even 18,000, how is that going to happen? Well, we have this very important area in the yen between 108 and 103.5, let's call it. And having tried to bust out of it, we've gone straight back into it. We think next week is going to be extremely volatile. We see both ends of the range being tested at some stage. If next week we manage to bust out of this range to the upside, that will be to us a very good indicator that the market has decided that the dollar is definitely going higher, and that stocks throughout the world will go higher too, but probably higher in the peripheral markets rather than in the US. So next week is going to be absolutely seminal in this respect. What dollar yen indicates is going to happen for the next several months. If it manages to close above the 108.25 area, we will turn very bullish on the Nikkei, and we will turn increasingly bullish on longer term on equities. We already think they are in wave 5, but we should get some catch up in different markets like the DAX and the stocks. If you look at the stocks, it's still way below the opening level of the year. The last price in the at the end of 2015 was around the 3,200 and something area. So we are a full good 15% lower than we were at the beginning of the year. We would then think that after a few weeks of hesitation at this level, the 3,100 level, we could easily see the European stock markets making a sustained break higher towards the 3,400 area. But of course we will keep you updated as our fundamental views change. But the takeaway from this is that we don't really see the possibility of a continuation of strong stock markets without cooperation from the bond markets. If the bond markets now start cascading higher in yield, and we go towards the 2% area, that will be a very early warning signal. But if they start going through the 215, 225 area, we think that the whole of the stock market rally is going to be in great jeopardy. Thank you.